We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Lobo Tiggre, author and publisher of the independentspeculator.com. Thanks for joining me today, Lobo.
Thanks to be back.
Excellent to have you. So, as we're right in the beginning of 2022 here, this really seems to be the year that everybody is looking towards the Fed. So whether it's its reactions to inflation, the rate hikes, the tapering, everybody wants to see what the market's reaction to all of this will be. So what do you think the outcomes of some of those actions could be on the markets?
I'll tell you, because I do have thoughts on it, but this has come up in my mind a lot lately. People keep asking me what I think about the Fed and all this stuff. Mm-hmm. And I'm not actually an economist. I hated economics in college. They taught me all kinds of outdated theories that all conflicted with my libertarian, anarcho-capitalist sensibilities. I'm not a political scientist. I'm not a Fed watcher. I'm not a person who actually makes a profession of reading the oracle tea leaves about, changing happy to glad in the Fed press release. So I just want to put that out there. I was for almost 15 years Doug Casey's due diligence guy. Mm-hmm. And now I hope to be the due diligence guy for the wider audience out there. That's my specialty is resource company evaluation, mining evaluation. But we have a context for that. So I just want to put that out there. Okay. I'm doing the humble pie thing because I'm not always right. People always ask these questions. And honestly, Tom, nobody really knows. We're all guessing. Maybe people like my guesses if they agree with them, but here we go. So the trends that make me want to guess is clearly, even though nobody saw it coming except for you and I and all our friends, inflation wasn't transitory. We just got the 7 handle this morning. That was expected, but it's still, way above the so-called symmetrical 2%. Mm-hmm. The core CPI at 5.5, way above the symmetrical so-called 2%. And interestingly enough, the core CPI catching up to the headline CPI, increasing more than the headline CPI did. So, these things really make it hard for the Fed. Even Powell has retired the term transitory, which I think is as close as we get to the Fed admitting it was wrong. Mm-hmm. But these things are a big deal, and it's not. A lot of people say, "Oh, it's Wall Street versus Main Street, and the Fed is beholden to Wall Street." But you know what? People feeling the pinch of inflation vote, and that does matter to the Fed and the people who appoint Fed nominees. We just heard that in spades yesterday in Powell's confirmation hearing there in the Senate, which was really sort of just a bunch of attaboy patting it backs and a bunch of grandstanding by the politics. They all know they're going to not rock the boat. They all know they're going to nominate him. So they all just took their chances, Warren to expostulate on their favorite things. So to answer the question, this inflation thing is real and has a political constituency that's up in arms about it. At the same time, I think the powers that be know that the economy is really not as robust as they claim. The so-called recovery, by the largest number of jobs ever in history created in 2021. Well, of course, the largest number of jobs destroyed in 2020. So even if you're not back to where you were before, which we're not, mm-hmm. you still create a bunch of jobs. It doesn't mean anything. The square root recovery, the question on the table really that we're addressing now is, where is that tail of the square root recovery? And it's still lower. And how long will it remain lower? Mm-hmm. I think given the continuing knock-on effects of all the shutdowns, never mind the medical situation, but the shutdowns from the pandemic, that's still ongoing now. Mm-hmm. That tail could last longer than from the great financial crisis. So, this leaves the Fed. So the question Fed watching, on the one hand, this inflation stuff is getting serious. Even Powell said this isn't the inflation we wanted. It's not what we expected. And they're talking much more hawkish and aggressive. On the other hand, they know that if they go Volcker, that neither the US nor the global economy can stand that. Everything is, I think, much more fragile. There's much more debt. There's also the issue of the U.S. government simply being unable to pay the debt if interest rates are normalized. All these factors, have the Fed between the rock and the hard place. So, I don't like to make these big, bold predictions, but I have gone on the record saying, I think this is the year the rock and the hard place slam together on the Fed. Mm-hmm. Now, exactly what happens as a result of this is kind of like a physics experiment. You slam these things together, you just see what comes out. But clearly, I think market volatility, to put it mildly, is the least we can expect. I think there is a very serious chance of a major market meltdown this year. Mm-hmm. What does that mean? I'm actually accumulating cash in advance of that. I don't know it's going to happen, but I think it's more than non-zero. I think there's a very good chance that, if the Fed actually walks the talk, they're talking tough, even talking about BS reduction. Fed never reduces its BS, but the balance sheet, they've been talking about letting that. I don't think that's going to happen, but they're talking pretty tough. So if they do that, I think you see a very strong market reaction. I think that creates buying opportunities in things that shouldn't be sold, like uranium stocks, which tend to sell off with the broader markets. And who knows what else, knock-on effects down the road. If they don't, though, that could cause just as much fireworks, because then everybody says, "Oh, look, their talk is worse than their bark is worse than their bite. They're not walking the talk." Whatever, mixing my metaphors here, and therefore inflation is going to be high, and they're not going to fight inflation. They're not going to win that fight, or at the very least, they're going to remain behind the curve. I think that's a given. I think the Fed remains behind the curve no matter what they do, because they're not going to be aggressive enough. I think they know that they can't do that without, head chopping consequences. Mm-hmm. So those are my unprofessional opinions on what is likely ahead for this year. I see high volatility. I'm accumulating cash. I see buying opportunities, not just in uranium, but maybe copper and other, of the key minerals that I'm looking forward to in case of this volatility. And gold and silver, I like them anyway. I don't need a market crash for those. They may face headwinds in the near term because of the Fed fighting inflation until it becomes clear that they remain behind the curve. So that's how I see it, Tom.
So do you think, Lobo, that the markets have priced any of this in? It seems like at very least the gold and silver community kind of expects a market pullback or a violent reaction to tapering and or rate hikes. So do you think that at any point the general equities have priced that in yet or not?
No, I don't. And remember what you and I might think, or most of our audience might think. We are this tiny, lunatic fringe as far as the mainstream is concerned out there. Mm-hmm. We don't matter. Our voices don't carry any weight. We certainly don't set what is referred to as the price of gold or silver. What we call the price of gold is really the price of futures trading on, the COMEX. I like to point this out. It's a mistake, especially people who get mad about it and say that that's not right. The price is wrong. Well, stop quoting that price. Those are futures contracts that traders who don't think like you and I trade back and forth. They have their economic models. They still think that inflation is a result of economic growth. And, so if we have high inflation, the economy must be doing great, and it must be okay for the Fed to raise rates, which would be bad for gold. That economic model is still programmed, not just in their minds, but in their trading algorithms, so that you see those instantaneous responses to higher dollar or interest rates, nominal rates and so on. That's still out there. Mm-hmm. And from those signals, I don't see that they're really pricing in a probable market crash, or even just, okay, the bull peaks and now we go into a bear phase. I don't see that priced in at all. And to be fair, given how much liquidity has already been put in the system and is still working its way through, people say Build Back Better got shot down. Well, the funds that were already approved haven't been spent yet. And even though the Fed is tapering, they're still actually buying, right? The quantitative easing hasn't actually ended yet. The policy is still easy and getting, the easiness is getting added. So I think it is a mistake to assume, let our blinders on, as government skeptics say, and say, oh, well, the crash is for sure. And it may not be. It could be that the powers that be just throw so much money at it that it keeps going higher. But I do think 2022 is different from 2021 on this. We definitely have, then an expectation of higher inflation. Now we have the reality. And I think the powers that be know they have to at least appear to do something about that. And I think that does, at the very least, make for, I think I'll be very surprised if the S&P gains as much this year as it did last, let's say, for example, or any of the three major indices. I think the very least we can expect is less growth in mainstream investments, which argues for looking elsewhere.
So as we're talking about that reality that we're now faced with of this, headline inflation being a 40-year high, do you think that we have basically seen the heights for inflation? The factors that are pointed to often are the supply chain breakdowns because of COVID, the lockdowns, things like that. So do you think that we have seen the highs for inflation and it will start coming back down?
Yeah, that's a more dangerous question because it's a near term, like what happens next. And given that we are actually still seeing more breakdowns, more lockdowns, I mean, even if Omicron seems to be, let me not pull my punches here. The data so far shows that Omicron is much less dangerous. And whether you even believe any of them are dangerous at all, let's set that aside for a moment. This one's not as bad as the other one, and it's more contagious. So this looks like the virus thing burning itself out, which I think is great news. But meanwhile, it's still there, and the shutdowns are still there, and we can't take any chances attitude amongst policymakers is still there. So you've got shutdowns, lockdowns, and economic consequences that still happening now, and the consequences of that need to play themselves out. I think it's premature to set all that aside. I think we need to expect volatility in the near term. If you believe the official Kool-Aid that all this inflation is just because of the supply chain disruptions and these temporary transitory causes, yes, those do need to end. I do think that ends. I mean, eventually, whatever happens with the germ, right? The market, the world adapts. The market sees damage and roots around. The world keeps going, and endemic, pandemic, whatever. We get over this, we move on. Those supply chain disruptions do eventually go away one way or the other. But what I'm saying is that they're still happening now. And so I think it's premature to say it has peaked already. And then there's the other whole side of this is, what if that story is wrong? What if it's not just all these transitory supply chain? What if money printing does matter, right? What if all these trillions, not just billions or hundreds, but trillions of dollars of new stimulus, and not just the easy monetary policy, but the fiscal policy. This is a big deal, and it takes time for this kind of, opening the floodgates of money to work its way through the economy. This is well understood for decades. So it ain't over yet. To get to the question of inflation, get back to that, has it peaked? I'm skeptical that it has peaked, but I can see it actually rolling over and the increases becoming less. In December, actually, we saw the monthly increases were less, but they were still quite substantial, taking the yearly rate to new highs and multi-decade highs. So key takeaway here is, even if the rate of increase decreases, it still increases on a very high inflation level already. Unless we actually see deflation, you've got high prices staying there and easing higher. High prices that are already causing pain for voters, staying high and getting worse. That has consequences. So I would say, don't get fooled about, decreasing monthly increases. High inflation that's still getting higher is a bad thing. And then for, gold and silver investors, people near and dear to our hearts there, the main thing, of course, is to look at real rates. And if inflation creeps up only 0.5% in March, but the Fed does actually increase by 25 basis points, the real rate is actually more negative. As you and I speak right now, Tom, we just have a new CPI print. The Fed is tapering, but it hasn't done anything with rates. That means real rates right now are more negative than they were officially yesterday. And we see that in the gold price. It seems to be, at least for today, the market is being somewhat rational and saying, you know what, this inflation is a problem, and that's good for gold.
So as we think about the inflationary narrative that gold is supposed to, account for inflation, we've seen gold be inversely correlated to the dollar over the past several years. So what do you think we need to see for gold to break that trend and become, as many have seen it over the past couple of years, an inflation hedge?
There's somewhat separate questions there. Tracking the dollar is one thing, and inflation hedge, they're related but somewhat separate. Let me just say that this business of gold tracking the dollar more directly than inflation rates is a historical aberration since 1971. I think that, I don't know, I can't prove it, and I don't think anybody really knows. We'd have to interview millions of investors and traders out there and average their answers. But my take on this is that once we sailed so far into uncharted waters, the Fed is intervening in the bond market so heavily, that the normal interest rate signal became more noisy, and traders started looking more directly at the dollar. And ultimately, if gold is traded and priced in dollars, or is a form of money that competes with the dollar, it makes sense for gold prices to be determined by the dollar. So why have interest rates been the primary driver for the last 50 years? Because markets are forward-looking, and the interest rates are a way of telling how strong the dollar will be or won't be in the future. So ultimately, it's always been about the dollar and its relationship to gold, which is why I like to refer to the gold price as the gold-dollar exchange ratio, because I see them both as competing forms of money. Mm-hmm. So ultimately, it's all about the dollar in the gold-dollar exchange ratio. But forward-looking markets have been looking at interest rates as a way of predicting where the dollar is going to be. And that's been a very solid relationship, like I say, for 50, now going on 51 years. But that broke down over the last year because we've got these topsy-turvy markets, uncharted waters, and I think more traders started looking more directly at the dollar. So let's put that in one place. And so what needs to make things go back to interest rates would be a more stable market regime, a more understandable economic situation where things go back to normal. Then you might see things go back to pricing gold based on interest rates directly or more directly. Mm-hmm. But will things ever go back to normal? What's the new normal can be? It might be that it never happens, Tom. It might be that we just see gold keep tracking the dollar going forward more directly. We'll see. Mm-hmm. Now, on the big inflation question, a critical point here is that people can cherry pick timeframes or get obsessed with particular timeframes that make things very confusing. A lot of people look over the last year, and I have people writing, I'm pulling my hair out. Gold's doing nothing. Gold's been a crap investment for the last year. What's wrong with gold? We have high inflation. Why isn't gold taking off? Well, in the first place, 1 year is not a particularly important time frame. You may want to make your millions this year, but that doesn't mean Mr. Market cares. And there's no reason to define the value of gold, the nature of gold, the nature of monetary phenomenon based on a 12-month time frame. But in fact, if you look at the 12 months, this is not a bad 12 months. What is wrong with 12 months of an $1,800 average gold price, Tom? $1,800 was a dream when I started in this industry. $1,000 gold price was a dream we'd love to reach some point. And you know what? In 2011, when gold spiked over 1,900, and it was obviously 1,800 on the way, gold was above 1,800 for a matter of days. Mm-hmm. It was a spike, a very vertical spike. And then it stayed, in the region for a while and it fell off a cliff. But we've had gold prices plus or minus around 1,800 for over a year. Mm-hmm. That is a great gold price at a level that makes tons of money for gold mines that were built on feasibility studies based on $1,300, $1,400 gold. There's nothing wrong with $1,800 gold. It's a fantastic price. And by the way, silver bucks, they hate me for saying this, but there's nothing wrong with the $23 silver price either. Mm-hmm. Not for mines that were tough enough to survive in a $15 price range. So in the first place, the last year doesn't prove anything on the big picture. The big picture is, if you look at since the end of the gold standard in August of 1971, the dollar chart and the gold chart are basically a somewhat curvy letter X. That's the reality of why inflation does matter. The big picture tells us, don't listen to any of these people who say inflation doesn't matter. The loss of purchasing power of the dollar is reflected in the reality of an ounce of gold. Mm-hmm. The 1 year time frame is frustrating. I get it. but is not particularly relevant. The really difficult one is the 10-year time frame. It seems like 10 years, it's a long time. It's a reasonable amount of time to look at something. But unfortunately, at least in 2021, a 10-year time frame took you from 2011 to 2012. So you have this big bear market. So it actually is like the worst. It's like cherry picking the worst possible time to say, well, what is gold doing? Mm-hmm. And I mean, it sounds reasonable, 10 years. Why don't we look at the last 10 years? But it just so happens that that's like the worst decade out of the last 5 that you could make that comparison on. So it's not a very useful comparison. But even there, I've talked too long already on this, but it's important to nail these points home. The other thing is that gold tends to lead inflation. Mm-hmm. So I'm looking at inflation expectation numbers, and the fact that those are going up are part of what makes me so bullish now. And when people say, what's wrong with gold? Why didn't it do better in 2021 with such high inflation? My answer is it did great in 2020 as a leading indicator that people were like, holy cow, inflation's coming. And they were right. And that was gold doing its job. So it led. Now we have, this uncertainty, what's going to happen next. And I think as the expectations for higher inflation, as core CPI creeps up, as that 7 doesn't go away, I think that helps reignite the fire there that we're all hoping for.
Yeah, that was exactly where I wanted to go next, was to see your thoughts on gold, really getting ahead of inflation in 2020. So thanks for hitting that point there. But I want to get your thoughts on, is there a material difference between the behavior of gold and silver in this market? Like, considering that silver is more of an industrial metal at this point, has its monetary status really changed to you?
Yeah, I've been writing about this. There's a free article on the website, Is Silver Losing Its Monetary Crown? If you want to throw tomatoes at me for saying that or asking that, daring to ask that question, you can look that up. Here's the thing. Actually, I don't agree that silver is more of an industrial metal now, but it clearly is headed in that direction. And this can be a very long conversation. Let me try to summarize it. I do see both gold and silver as monetary metals right now. I think that most people around the world still see silver as, the poor man's gold. I don't like that term, but that's the mentality out there. It is the monetary metal if you can't afford to buy an ounce of gold. I think that's no longer really necessary now that there are fractional ownership options out there. And but that's still the way a lot of people think. There are a lot of people that will stack physical silver, and not just silver bugs in Canada and the US, but normal people in India or other places around the world will stack silver if they're worried. If they're worried about the paper money, they will do that. Mm-hmm. That I think may change as the industrial aspect of silver kicks in. I think in the future it may change if we adopt some digital form of gold, in which case, the digital form is infinitely divisible. So you don't need silver to make change for gold in some future gold standard world. That's not our world today. People hate me for saying this, but I can see a world in which a new gold standard is adopted and it's not bimetallic. You don't need silver for that. It's kind of like saying, there'll be $100 bills in the future, but we'll need $1 bills too, and we like $1 bills better, so we're going to stack $1 bills. It makes no sense. You can always make change for a $100 bill in the future. So let's put that aside for the moment, because that's the future that we're not in now. I think the important takeaway here is whatever happens with this divergence between gold and silver, and there is data showing this. Like, people get mad at me for saying this. I'm just saying, look at the data. What happened in the crash of 2020? Gold and silver both tanked. Gold came right back, and silver just struggled for a year. Mm-hmm. I mean, we see the metals behaving differently in the markets now already. So I do think it's dangerous to ignore that. But I do think there's still both monetary metals, and that will last for years.
Excellent. So, Lobo, how do you evaluate the miners at this point? Were you a buyer into the end of the year tax loss selling weakness that we just saw?
I was, actually, and I got a little bit early on that buying. But here's the thing. Going back to our initial comments, I see headwinds from potential economic knock-ons to Fed tightening or ECB tightening. So I'm not in a big hurry to buy more industrial metals right now. I love the copper story. I think that's a multi-decade bull ahead, but I'm in no hurry to buy more copper right now in the face of that. I like the uranium story a lot, but the stocks went up a lot already. And if there's a big market correction, uranium stocks will get whacked. They always do. So, I'm not in a hurry to buy more of that now. But gold and silver, they may or may not correct. I think objectively, as forms of competing money, they're undervalued and the stocks are deeply undervalued. So those I'm willing to buy. And I did buy several stocks going into the end of last year that had been on my shopping list and came available at good prices. I'm revisiting my shopping list now. I would say actually, except for one uranium stock that's still on my shopping list that I'm hoping the market will come to me on, I'm looking more at new gold and silver speculations than anything else right now. And everything else, I'm waiting for lower entry points. Mm-hmm. Now, this is because I already own a lot. I own a lot of uranium stocks right now. If I didn't have any uranium and I missed what happened last year in 2021, and I was wondering, is it too late? My answer to that would be no, it's not too late. If I didn't own any, I would be looking at a lot of the uranium stocks that have corrected already. I would probably buy a copper stock or two. I would want to have a finger in the pie on some of these other things. But since I'm long already, I think there's a good chance of better prices ahead, and that's when I want to buy more of. Gold and silver, there might be some headwinds now, but in the negative real rate environment that we're in, I just don't see a whole lot of near-term downside in them. Never say never. I could be wrong, but I'm putting my own money there, and I am certainly willing and able to buy another great gold or silver stock speculation if I find one. Passes through my due diligence gauntlet, tomorrow.
Mm-hmm. And exactly in that vein, Lobo, you said before the interview that you're a very disciplined and diligent speculator. So can you walk us through some of the rules that you kind of keep on hand that really constrain your framework on what you want to be speculating in?
Sure. Well, to begin with, and to give credit where due, I would give a nod to my mentor, Doug Casey, and his famous 8 Ps of resource stock evaluation. I think they had become 9 at some point. They had started out, I think, as 6 or 7. But, people, property, politics, price, financing, promotion, all these things, all that is still there. I think Casey Research still has it's not mine, but it's a free download for anybody looking for the whatever Ps of resource stock evaluation. I think those are very good principles. What I add to that is, I guess there are certain sweet spots that I focus on, Tom, because there's thousands of these mining stocks out there, and they can't all do well. And many of the juniors, they're going to take investor money to money heaven. You can't all make a discovery. So personally, and I understand that, some of these big 10, 20 baggers overnight type stories are on those wonderful discovery holes, but nobody can predict those. That initial discovery is not Doug Casey, not Rick Rule, not me, not anybody I know can reliably predict a wonderful, world-class discovery. And the way these guys grab these is by having a very broad net. They can afford to buy lots of these stocks. Most of us can't. So honestly, I just don't speculate on pre-discovery exploration. If I did, I would bet on a prospect generator. That would be the only way I'd do it. And so what do I bet on? Some of the sweet spots are the pre-production sweet spot itself. This is one of my claims to fame, is the research I did on that. That's a free download at independentspeculator.com. You can look for the pre-production sweet spot report. It's free, which, as far as I know, I was the first one to actually put some numbers on this. And the re-rate from exploring to producing is on the order of a double on average. And some of them are almost 10 baggers. So I like that a lot because it's a higher probability at substantial gains. So I like the pre-production sweet spot. Instead of pre-discovery exploration, I do like exploration because it does add value when it's successful. But I like to look for what I call success in progress. And that means missing out on the first discovery hole, but watching for companies that are delivering. Like when their geologic model works, it's predicting. They just keep hitting, boom, boom, boom. They think it's a vein, or they think it's a disseminate, whatever it is, and they keep hitting. A discovery doesn't happen with just one hole. That's the initial discovery. Between there and defining a 43101 compliant deposit, you've got hundreds of drill holes, and they all add value. So after the initial discovery, the stock might only go up 3, 4, 5 times by the time they have an economic deposit. But you know what? I'm fine with a 5-bagger. The odds of a success in progress play delivering a high multiple are much better than any of these thousands of would-be juniors out there making some world-class discovery starting from scratch. So I like the pre-production sweet spot. I like what I call success in progress. On the early stage, I personally like generators, prospect generators. I don't have any in the portfolio right now because they can take a long time to deliver, and readers get impatient with that. And then I also am partial to the small or single asset producer with either growth or takeover potential. And we've seen the takeovers heating up lately. I think 2022, this is a key takeaway here. I think we're going to see a lot of M&A activity in 2022 because it's been reduced for the last couple of years. And mining is a business that by its very nature puts itself out of business. If a mine is a self-depleting asset, you have to discover more or buy more. And if pandemic shutdowns make it impossible to travel and explore or to do due diligence on mergers, all this gets put off. So I think we're going to see a lot of M&A this year, Tom, and I think that is a great area to focus our speculative dollars on.
So as we think about the issues, let's say, facing miners over the next 5 to 10 years, what are some of the trends that will play big roles that we need to think about taking into account that maybe haven't mattered as much in the past? Will ESG play a larger role on the success of some of the miners, or political risk in some of the jurisdictions that we have typically considered being safe?
Yeah, well, we can specifically ESG is the big one there. Though I would also say that the other trend here worth watching in this area is the new renaissance in the nuclear area. The climate change battle has brought more and more people around to this idea that, we may not like it, we may be worried about it, but without nuclear power, we're not going to achieve these climate change goals. So that is, I think, a big exogenous factor that is really relevant to us as resource speculators. Mm-hmm. But the one you allude to, I think, is also actually very important. I've been thinking more and more about this. I published a free article. It's called ESG, the most valuable bullshit, BS on the market. I don't want to be a polluter, and I don't want to invest in polluters. I'm not trying to say that none of these things have any value, but I do believe that the purpose of a business is profit. And if you forget the profit motive, that's actually less efficient for society, and it produces negative outcomes, including ESG outcomes. And it's I think it's wrong-headed to blur the line between nonprofit goals and for-profit goals. That's all I'm saying. That said, I actually will push back a little bit, Tom. It's not that these things weren't important before. We just had a different name for it before. We called it being a good corporate citizen. And good corporate citizenship has been in fashion, if you will, for a very long time. And mining companies, it's not like the bad old days where, honestly, there were some bad things done, very destructive to the environment and or to people. But that's not the way it is anymore. And companies understand that if you're not a good citizen locally where you operate and where you're headquartered, you're going to have more problems. So with or without the regulation, though the regulation has certainly had an impact, the customer, if you will, and the investor demands placed on the companies, I think, require good corporate citizenship. But that doesn't mean nothing's changed. Clearly, the thumb screws are tightening. Mm-hmm. This is a big deal, Tom. I think this is actually something critical to my views going forward. I've always been more sensitive to political risk than my mentors. They've been willing to, take a shot in Ebola Central, and I I've got my posterior handed to me so many times doing that. I never say never. Well, I do have some no-go zones. Like, I'm just not interested in Peru right now. And I've been completely out of Bolivia for many years, things like that. Other places, it takes a deep discount. I will invest in African countries, some of the better ones, but I want a deep discount for the risk. That's always been there. But this ESG thing is really ratcheting up. And I actually think it could completely change the political risk landscape. Places that are pretty solidly pro-mining, like Ghana, say, or, those could actually become much better mining jurisdictions than Canada or the US. If the ESG requirements become so onerous that you just can't permit anything. Like, who, it's great to have, courts that are solid rule of law and all that stuff. It's great to not be shot on your way to work. But if you can't get the mine permitted at all, you have no mine. You're out of business. So it remains to be seen exactly how this plays out and how quickly it plays out. But I think this is a real powerful trend that investors need to be aware of. I think you could see, for example, the Fraser Institute's rankings just completely upended as more, woke countries become less and less friendly to mining. It's not an environment for passive investing. People need to be on their toes, need to watch for changes. This is a big deal, Tom.
Mm-hmm. You've mentioned how excited you are about the uranium space several times here, Lobo. Does any of that bullishness extend from the recent upheaval and unrest in Kazakhstan?
No. Actually, I've gotten a fair amount of pushback and heat from my fellow uranium bugs. So what's wrong with you? This is it. Uranium's going to the moon. But you know what? Let's pull back to the bigger picture, Tom. I think it's very dangerous to react instantly to headlines because you have or some reporters take on what's actually going on. That's not a trend to invest on. Now, granted, if there's some huge blow up and you see the obvious implications and you want to get ahead of that, I can see that. But don't confuse that with, disciplined betting on a trend in motion. It's a gamble. We see this headline, it looks scary. Oh, that could be great for uranium prices. Fine. If you want to do that and guess and get ahead of the market on that, fine. But understand what you're doing. Mm-hmm. And then so, the next day after all the uranium stocks spiked on that news, they came crashing down because Atomprom came out and said, we've got no problem. None of this affects us. Mm-hmm. Today, as you and I speak, they've said it again. We're fine. There's been no disruption to our operations. We anticipate, nothing to impact our supply right now. However, they did say that while they're secure, with or without the help of the Russian army, while they're secure, some of their supplies, like you need reagents for your solution mining and all this stuff, some of their supplies are not secure. So they have not yet said that their output will be impacted, but they've said that there could be an impact. This is, to my mind, is the first real hard evidence that makes it more of a trend that you should consider. Mm-hmm. So to my fellow uranium bugs out there who got mad at me for not jumping on the cheerleader bandwagon, oh, this is it, uranium's going to the moon. I would just say discipline matters. And it could have been, but it could have all just blown over very quickly and turned into much less of a thing than it has been and may still yet to be. Mm-hmm. It pays to be cautious. So my bullishness on uranium is completely with or without changes from Kazakhstan. I'm a fundamentalist, and the fundamentals have been very strong for years. On top of that, over the last 5 years, the technicals have been good. We have a solid upward trend with a lower trend line that has not been violated. So the fundamentals look really good, and the price action has been good over years. Still not good enough. So that means there's plenty of upside. Unlike tin or copper or even gold or silver and many of the other commodities that have gone up, uranium is still not at a price that pays the industry to mine it. So that's a great setup. That's why I'm bullish, Tom. And then on top of that, so the big market changes in Kazakhstan, the big change, and I do think this is a significant change in the market, is spot, right? Spot comes in last year, hoovers up all the cheap pounds. That matters. Before that, nobody really knew how much cheap uranium there was or how many sellers might be willing to sell a few pounds and keep the spot price down. That's cleared up now. And I think that puts a not, fundamental bedrock of the universe solid floor under uranium prices, but I think it puts a significant floor under uranium prices. Mm-hmm. And it's absolutely no surprise to see it come down from 50. That's more than a double for a lot of people who speculated at 20 or 25, right? So of course, higher prices attracted some new sellers. But the market data, in my opinion, is telling us that those supplies of super cheap pounds who didn't care about the price, that's gone. That's been cleaned up. That is a change in the market. So we've got fundamentals, we've got the technical trend, you've got this source of cheap supply cleaned up, with or without supply disruptions from Kazakhstan. The setup here, could barely be more bullish. It's a price it's a when, not if question. And the when looks like 2022 to me. Mm-hmm. With the one caveat, sorry, I got to say this, Tom, my uranium bug friends hate it when I say this, but with the caveat being that if there is another major nuclear accident, all bets are off the table. This is a speculative thesis that on the fundamentals and everything else, I am super bullish on. That's just assuming nothing else really bad happens. Now, I'm not those are lightning strikes. I don't expect that. I'm willing to bet my money that it's not going to happen anytime soon, or maybe even ever again. We learn from each one of these. But I need to put that out there. I don't want anybody to put a bunch of money on uranium stocks and then there's an accident and say, oh, Lobo, you told me this was a sure thing. No sure thing. Mm-hmm. But absent that, I think this is this is my favorite resource investment for 2022. I think the risk reward in the uranium space is the best. I like it a lot. And I have more uranium in my portfolio than I've ever had before.
Yeah, it seems that SPUT has really brought a lot of transparency and price discovery to that market where there was a lot of opacity before. But I want to go back to something that you had said earlier and, explain to us a little bit more about why the uranium stocks seem to be so linked to the general equities. If we see a crash in those, is that time to load up on uranium equities as well?
Yeah, I can't really explain why. We can just say, uranium stocks are stocks. And when the stock market goes down, stocks get affected. But they seem more prone to it than, say, gold or silver stocks. It's fairly common for gold to have a good day when the markets are tanking and gold stocks to have a great day while stocks in general are going down. So it's not enough to say that, well, stocks are stocks and they sell off with the market. I don't honestly know why, Tom, the uranium stocks are so vulnerable to that. But it's actually good news because these things are day-to-day fluctuations. Mm-hmm. I'm not saying that uranium stocks ignore the price of uranium and that if markets are going down, uranium stocks will go down and stay down forever. That clearly is not true. Uranium stocks had a terrific 2021, and I anticipate them having another terrific 2022, even if the markets melt down. So pull back to the big picture. Your investment time frame, uranium drives uranium stocks with leverage, and that's the reason to speculate on them. That said, on any given day, for whatever perverse reason, it's really striking that you can see uranium stocks all in the red on a day that uranium prices are actually up, mm-hmm. or the reverse. You can see uranium stocks all in the green because markets are up on a day that uranium is actually down. It makes no sense on a day-to-day basis, but that's great because it creates buying opportunities. And the big one here is if I'm right that there's likely going to be a major market correction in 2022, as the Fed gets serious or, as push comes to shove and they have to do something about inflation, I think we could see some terrific buying opportunities, especially for people new to the space who thought they missed it in 2021 or people who were cautious and maybe bought some, but not enough. I think we could see a great buying opportunity this year because if the markets melt down, uranium stocks will absolutely get hammered. And that's not going to have any impact on uranium itself at all. I mean, it's the lights still need to come on, whatever the markets are doing. The Chinese are building 150 more plants. The European taxonomy issue should be settled soon. And, we could see more money going into this space. So I'm not going to say that, as an energy commodity, I'm not going to say that uranium is entirely recession proof, mm-hmm. but it is different. It's not like iron or even copper. I think uranium can face headwinds at certain times, but it's still too low price to be mined. And we need the more mine supply. So that's why I say risk reward. This is my favorite commodity in the space, and just take that market noise as opportunity.
So Lobo, we've kind of touched on a couple other asset classes, but where do you see, let's say, your excitement level for some of these other areas, like let's say copper or oil or anything to do with the electric vehicle raw materials? Are there any of those spots that you're looking at as well?
Yeah, all of these components are interesting to me on the energy side, but they're complicated markets. And so, for example, there's a lot of green minerals play experts who are very bullish on copper and nickel, and I'm generally bullish on both, but there are wrinkles in the nickel space mm-hmm. that change. And, some of the constraints in the nickel space coming off there's this talk about this new process the Chinese are developing for battery nickel, battery type production, converting pig iron nickel to this sulfide battery stuff. I'm not a chemist. I don't remember the details of these reports. And I'm always kind of suspicious of new processes. Science projects are not really what I invest in. But that could be a significant game changer in that market if it rolls out and they deploy it commercially. If anybody can deploy that commercially quickly, it would be the Chinese. So, in cobalt, the battery makers are looking to reduce the cobalt content. A lot of these things make me nervous. The one that I'm least nervous about is copper. So I'm not saying don't invest in anything else. It's only copper. I'm just saying the one I have the highest confidence in is copper. And that lasts for decades. Whatever headwinds we might run into this year, economic turmoil, I would see those as opportunities because I'm highly confident of copper going over, higher over the decades to come. So that's the way I look at these things, Tom. Mm-hmm. The oil one is interesting to me. Lynn Alden is actually the one who gave me this idea. I liked oil already, but she gave me the idea of thinking about it like the tobacco companies back when those were coming under the thumb screws. And that's what's happening now to oil. It's becoming hated. It's reducing the capital available to go into the sector. But that's plan A, and plan B is still not ready yet. We still don't have enough windmills or even nuclear power plants to run all our Teslas and things around the world. So I actually think that ESG is going to drive oil prices much higher. And if investors hate the companies so much that even if they're making money hand over fist, the share prices don't go up, then the companies will pay that back to investors in dividends. Mm-hmm. So either through capital gains or through dividends, I think the oil space, ironically, the more heat it gets from ESG for a time until it actually does go out of business, will actually deliver very well for investors. But near term, there are headwinds there too. Winter's coming, could be more COVID-19 shutdowns and scares. I don't know what happens in the very nearest term. But I find myself, the more I think about it, the more persuaded I am that ESG and green mandates are actually going to drive oil prices higher. And there should be a lot of money to be made in that space.
And like you say, we're seeing signs all over the world that plan B isn't available while plan A is still needed and necessary to power and heat much of the world still, right? Yes. I mean, don't get me started on the politics of this topic. It is insane. And it's backfiring. look at the coal consumption recently that's been making the headlines. Mm-hmm. If you try to say, okay, we're not going to use this form of energy when the next form of energy isn't ready yet. Like, even if I completely bought everything that the green agenda believes in, I would say, you can't starve 9/10 of the planet to death. The people are not going to vote for that. Mm-hmm. So you need a politically viable plan to get from A to B. Mm-hmm. You can't just kill A when B's not ready. We don't need to repeat ourselves on this. But I do think this creates opportunities. And maybe one more useful thing that we can do for the audience in this is, at the same time, you've got the ESG mandates manifesting themselves in the NIMBY form, like not in my backyard. Mm-hmm. And even, never mind oil, but even lithium, that's getting protested to mine lithium in Europe, and not the Atacama Desert where water is an issue. Mm-hmm. So this NIMBY thinking on the one hand and the green mandates on the other, that doesn't work. Something's got to give there. Mm-hmm. And, it's unfortunate, but I think it's going to drive the relevant commodity prices much higher, actually. Mm-hmm. You're going to have supply constraints while demand goes up. That's the perfect setting. Absolutely, Lobo. I want to thank you for a really wide-ranging conversation that we've had here today. Is there anything else that you'd like to mention before we wrap up? Yeah, this is where I'm supposed to sell my newsletter, but I'm not going to do that. Everybody knows where to find me if they want. I just want to really emphasize that I see 2022 as a year of high volatility. This is not a year for passive investing. I think you need to be very careful about stock selection, not just which commodities or metals you want to invest in. I think you need to do your due diligence. You need to take the time to research your investments. If you don't have that time,
honestly, I probably wouldn't even go with the stocks. Like if I'm a gold bull, but I don't have time to research gold stocks and which ones are the best ones, I just buy bullion. Or if I'm persuaded by this oil thesis, but I don't have time to research the better companies, I'd buy an oil ETF or something like that. That I might do. But in general, this is the key takeaway. Given the rock and the hard place coming together on the Fed, and that it could result in a number of very different pathways, this is not a sort of year where you can set any trades and walk away. I think everybody needs to be on their toes and pay a lot of attention. This is a year for active investing.
Mm-hmm. That's some excellent advice there, Lobo. Of course, any of your links and everything is all available on your website, theindependentspeculator.com. Lobo, thanks so much for your time today.
Thank you, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.